Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey, folks, welcome back. Today, zooming in from Orlando, Florida, or parts thereabout, we've got a very experienced real estate entrepreneur in many senses of the word. So Travis Watts has been an active investor. He's been a capital raiser. He's been a limited partner on quite a few deals. He knows real estate. He knows multifamily. He knows investing from multiple different angles. So today, we're going to get his perspective, his experience. And Travis, thanks so much for being on the show.
Well, thanks for the invite, Dave. It's been a minute since I've done a podcast, so I appreciate it.
Well, you used to be a host for Best Ever. You've interviewed hundreds of people, that's for sure. So it's great to have you on as a guest. So maybe let's take a little snapshot. As we're recording this, Travis, it's already the middle of 2026. My God. Yeah. What does real estate investing look like for Travis Watts right now? What do you do?
Yeah, that's a great question. Still, for anyone that knows my story, has seen me anywhere in the past, I'm still a full-time limited partner. Okay, so I'm still doing lots of different asset classes. I'm an investor in multifamily, self-storage, mobile home parks, REITs, debt funds, car washes, all kinds of things. So I'm continuing that journey.
How many of them are you involved in at this particular time?
At any given time, including now, it ebbs and flows to about 30 deals, give or take. So, it's been a little slower the last couple years. We've had capital calls and other things to save some money for, and just building up a cash cushion for new deals. So, we just came out of a very interesting capital market cycle with interest rates that reset.
That's a nice way to put it. Interesting.
Yeah. We reset some valuations. We reset a lot of assumptions among investors and GPs and all the rest in between. And it's been so interesting how different the commercial space has been throughout these last few years as compared to the single family space, which is where I started. In 6.5 years of single family homes and flipping and vacation rentals and all that. And just so many lessons learned, if I could just put that as simply as that. And happy to dive into them, but that's kind of where we're at, is coming out of a somewhat of a recession, though not broad-based or government-wise or other, but capital market recession for sure.
Okay, so based on the fact that you've got a ton of experience investing in multiple different asset classes, kinds of real estate, what are you feeling a little bit more bullish on right now?
That's a good question. So, I've had kind of that advantage, right, to look at a portfolio being my own as we went through a nasty cycle, and to see what was more resilient, to see what worked and what didn't, to see what the weak points were, some of which I kind of figured that, it would play out that way. Others I was just totally taken by surprise. So to get to your answer there, self-storage was a big one for me. It was something I'd only dabbled in. I've done 2 or 3 of these deals, different operators, and I was so heavily concentrated in multifamily, which I still love, by the way, and that was my long-term background. But I was just looking at not just the asset class, not just to sit here and say, well, self-storage is better than multifamily or vice versa. It was the type of structure is really what it kind of came down to. Lower leverage, different types of dynamics, different types of customer base. One thing I'll point out as a practical example is in multifamily, we were having a hard time just bumping rents even, 2 or 3%. It was really a struggle the last few years. Well, in self-storage, because the price points are so much lower, the regulations are so much less, broadly speaking, it's not uncommon to bump rents 20%, in a given year. Now, it's not like you do that every single year, but still, someone paying $100 a month is now paying $120 it's not exactly breaking the bank, right? As compared to 2,500 rent or something like that. So
Exactly.
anyway, it held up, through, I've been in these deals since the pandemic, since the inflation, since the interest rate cycle and all the rest. And I decided I'm going to move that direction for the next chapter here. And I'm going to be a lot more heavily concentrated in that sector.
Very, very cool. All right. Well, that makes a lot of sense. It is one of those asset classes that people say is pretty recession resistant. Nothing's 100%, that's for sure, but a lot more resistant. So your background is in multifamily. You've done a lot of multifamily deals as an LP.
Yeah.
Would it be fair to say that a few of those have gone sideways over the last few years?
It is, yeah. I don't have a percentage, but yes.
Yeah, well, I'm just really curious, Travis, because you've got a lot more insight and insider information into the market than the average LP would, right? I mean, the average busy doctor, dentist, lawyer, what have you, they're busy working in their jobs full time. You're immersed in this. So I'm pretty sure that, you weren't willy-nilly about who you invested in and the deals that you invested in. What were some of the things that kind of took you by surprise, 2020 hindsight, looking back on things? Any lessons learned from some of those painful experiences?
Absolutely. And, the most common theme that I experienced and that a lot of people have is, I think a lot of us knew if we go back to 2021 and we have a conversation in general about floating rate debt, I think most of us knew, hey, bad idea. Look at 2008, 2009. Isn't that what led to the whole meltdown and the crisis and why people lost their homes? And okay, I think we're all on the same page there. However, in commercial real estate, it's common to have short-term debt in general, right? You're not locking in this 30-year fixed rate kind of stuff, right? Yeah. And floating rate and bridge debt's pretty common too, especially among kind of value add plays, or, maybe you're doing a development project or you're repositioning a property, in general. And so I think what a lot of us thought would be okay is if you had floating rate, you would buy an interest rate cap, kind of like an insurance policy, to kind of cap you at a certain threshold in case rates go up, you're so-called protected. I think one huge curveball that I've talked to so many GPs about this, and it was certainly a curveball for me, is the cost of that cap. First of all, it needs to be renewed. And usually they're 1 year, or 2 year, or 3 year caps. So when that renewal came up, we may have paid $100,000 for it initially in 2021. Now we're looking at paying $1.1 million for the same cap. Yeah. Now, obviously that's problematic, but times that now by a portfolio of properties. Let's say an operator's got 30 deals. Okay, where's $35 million going to come from overnight? And that just might renew it for another year or two, right? And so I think a lot of people assumed, okay, they're going to raise rates, but they'll lower them too. And it hasn't happened. And so you have this kind of downward spiral of, maybe your distributions got paused, and then, a capital call because they need more money for these rate caps or for CapEx or other reasons. Inflation took off, rents came down, values came down. You go to the bank and try to refi, and it's like, hey, you got to bring money to the table. So again, where's the money going to come from, right? You don't have equity in the deal. So more capital calls, and a lot of what's happened, including in my portfolio, is lender forced foreclosures or forced sales, pref equity partners being impatient or being able to force, the levers unfavorably. There's a saying, I don't know who coined it, but you never lose money in real estate unless you're forced to sell at an inopportune time. And I think that's the story of what's been unfolding. Is if you've been a seller the last couple of years, the odds are it probably wasn't great. You may have made some money or a break even, but a lot of people have lost a lot of money. So, in my portfolio, I had some floating rate exposure with some operators, and I also had fixed rate non-floating, which has been operationally fine without capital calls or pause distribution. So it's interesting to talk to LPs in 26 because you have people who have gotten in the last year and a half and are stoked and excited, just like it's 2021 again. They're finding great deals at great basis, that cash flow, that are structured properly with good capital stacks. I get it. And I'm so thankful that we have people coming in the space in the last year and a half. But for those that went hard and heavy in 21 and 22, it's a different story.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Yeah. Good points. Yeah, that makes a ton of sense. And it wasn't the fact that everybody was greedy. It was just the modus operandi for how financing is structured with multifamily deals, and everybody kind of got caught with their pants down. But nobody had that crystal ball. That's for sure. Very, very interesting, Travis. So that was the next question I had for you. Is a lot of people are saying, well, okay, things are starting to turn around. Prices are becoming a lot more reasonable, especially with banks taking over deals and having to get them off the books and that sort of thing. Where do you see multifamily going over the next year or two?
It's going to, in my opinion, without a crystal ball, it's going to be a slow turnaround. It already has been. We've been years now in a down cycle. And I do think there's a lot of, grass shoots that are happening. I mean, they really are statistically starting to turn around. You can see that by so many different metrics, but it's not like the stock market. I think that's where a lot of investors get it wrong is, these V-shaped recoveries in stocks, and COVID, 30% down and 6 months later, all-time highs. Like, it doesn't work that way with real estate. It's extremely slow moving. And to your point about if deals are foreclosing and those numbers are getting recorded, that's still hurting values, right? Those are still comparable sales. And to a point, that still matters, even though NOI kind of drives the valuations and whatnot. So the great thing is if you're working with a good operator and they're able, it's still highly competitive out there to buy, and they're able to get some of these deals at great basis with fixed rate debt, or no pref equity and just a clean slate, maybe lower leverage, maybe 50% leverage, not 75 or whatever it may be. I'm just spitballing some ideas. I think, and when I say I think, I mean, I'm investing in this market for those reasons. I just really think there's a positive momentum. And then one big thing I didn't mention, I don't want to forget, is how developers have scaled back in this market because of rising rates and higher inflation and higher wages and all the things we just talked about. So that means, less supply coming to the market, which has been the story of the last 2 years in multifamily. Lots of new supply in the hot markets, especially, but that is burning off so fast. I mean, it is falling off a cliff. And so while painful today, if we can just zoom out 2 years into the future, I think that's a huge catalyst to be bullish on commercial real estate. So as far as what rates do, it's anyone's guess. I'm not even going to take a gamble. Higher, lower, same. I don't know.
Who the hell? There's always a curveball being thrown at us, so who knows where the hell things are. So Travis, another thing that you're intimately involved in is raising private capital. You've got a lot of experience with that. You've been involved in investor relations for quite some time, which is wonderful because, I mean, you see both sides of the card there. Like you've got tons of experience as an LP and working with GPs as well. What are you seeing these days as far as raising private capital for multifamily? What's the same? What's different? What approaches are working better now? What's not working as well as it used to? Where do you see things?
Yeah, it's a great question. I think, first of all, LPs in general are asking better questions. Okay. They're caring about basis. They're caring about debt structure. They're caring about capital stack. They're caring about discipline. It was in 21, a lot of LPs got into the multifamily space between 2015 and 2022 at the blow off top, right? And after seeing deal after deal after deal after deal be a success and a hit, and these 20% IRRs and these double your money in 5 years, it kind of, I would say it got loose on due diligence for a lot of investors. It was just like, I'll just, I don't know, spread my money out. I know this guy. I met this person at a conference. I don't even know their name, but I'll do a deal with them. And so it got way, way, way too lax. And that's when it all went wrong, So operational discipline, I've been a big advocate for years. I mean, my entire career has been about investor education. That's where I really play in. And I think that's more important than ever. People don't want the basics of like industry terminology. They want to know exactly where their money's going, how the money gets produced, what the real risks are, and so you're having to do a lot more legwork in a good way as a GP or an IR rep or something like that. So that's kind of what's changed and where we're at, other than the obvious structural changes to debt and stuff like that.
Yeah, makes sense. Awesome, Travis. So as we're kind of wrapping up our conversation here, who are you looking to get connected with these days?
I love connecting with LPs. We like people like ourselves, right? Mm-hmm. So I connect on LinkedIn. I'm very active on LinkedIn. So reach out to me, Travis Watts. Be happy to connect. Not here to sell anything to anybody. So if you just want to connect as an LP, talk about deals, talk about sponsors, talk about cash flow, talk about financial independence, whatever your thing is, it's all my world. It's all my passion. So that's the best place to find me and to connect.
Awesome, Travis. Well, hey, thanks for your insights. Really appreciate it. It's been great getting to know you a little bit.
Thanks so much, Dave. Thanks, everyone.
All right, everybody, take care, and we will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviewyou.com.